with, I want to give my name is Nate Tobik, and if any of you have heard of me, I write a investment site, Oddball Stocks, and I have started this company, Complete Bank Data, also one of the organizers of the event here. And so I want to just give a quick talk about getting rich with small banks. And this is an area that is of interest to me, obviously, as I have a banking software company. And I think it's of interest to investors because this is a great space as well. So if you aren't familiar with me, as I said, I write at oddballstocks.com, and these are out-of-the-way opportunities, pink sheet companies, small companies that the market has generally ignored. And and then obviously the small banks fit into that, and these are American banks. There aren't really any small Canadian banks. And so then in 2013, I started this company, Complete Bank Data. And basically what we do is we take all this regulatory information on banks and we combine it together for this holistic view of what a bank looks like. So data from the FDIC, the Federal Reserve, the SEC, some of the regulatory insider filings, and you get this whole view. And then we have tools and analytical capabilities built around that. So you can find us on the web at completebankdata.com, or if you have a Bloomberg terminal, type apps banks go, and we have the program runs inside of there. So as I was thinking about this talk, I started to think, I could probably talk all day about what I consider the small bank pressure cooker, which is all these regulatory issues, the aging bank boards, how many small banks are just out of date with technology. And it would be a fascinating talk for most people. Some people might fall asleep, and that's fine. But you know, the reality is everyone's here to find investments and to make money. And one of the best ways to make money, I believe, is investing in these small banks. So there's a lot of dynamics that are causing these banks to merge and be merged. And so as an investor being in this space, there's a lot of buyouts. Banks last year, when the market was flat up slightly, most small caps were down. Small cap banks were in the positive territory. And so it's a really good market. And so I thought, instead of just talking about market dynamics, I'm just going to pitch a number of banks. So I have 6 banks I'm going to go through. If anyone wants to know why these are so great after you see these slides and want to hear about all the regulatory issues or issues with bank management, come find me. It will be out at our booth in the back there. So this is a slide from our software, and this is just a small snippet of the opportunity. And these are all banks with under $1 billion in assets, which that's the threshold that the FDIC has basically said, we don't want you to exist anymore. So all of these guys, these are all traded banks, need to somehow get above $1 billion. The way they do that is they're going to be purchased or they're going to be purchasing someone else. And so if you look at that red rectangle there, what that is all of the banks that are trading below book value and have a 7% return on equity or above. And my thought is you just buy inside that rectangle. And as you can see, there's a ton of opportunity there. And so the banks I'm going to go over are just representative of what you could find in there. Some of these are great banks, some are average, they're going to be purchased, but it's just representative. So these aren't the best opportunities. There's probably some banks you guys know about that I don't know. You know, I left them off because there's too many to know. So of the 700 or 800 of these small banks, there's a lot of stuff you could purchase. So the first one up is Sturgis Bank. These guys are in Michigan. It's a $360 million bank. They're trading for 70% of book value, and they own some insurance operations. They also own a trust management company. Now, they consider themselves a $1 billion bank because they look at the trust assets and they look at the insurance and they say, well, if you add all that, it's about $1 billion. But it isn't. It's only $300 million. And they've done well. The largest loss they had was $395K in 2010, which is probably less than most people lost in their house in the financial crisis. So they've done well. They've managed their portfolio well. They're on the acquiring side. They purchased West Michigan Savings Bank. They purchased them in 2015, and this is a $35 million bank they purchased for $3 million. And it's a tiny bank, And it's a great example that at 35 million, West Michigan Savings really couldn't turn a profit on their assets. And Sturgis is able to. So they take out all the inefficiencies, they combine the core systems. The core processing system for a bank runs about $500,000 to sometimes $1 million a year just to get that back-end IT system. And the Sturgis earned, it was a 7.8% on equity last year. The preview into what's going to be going on going forward, they did 10% in Q4 2015. So I think at 70% of book and 10 times earnings, this is far too cheap for this bank. They're just a typical neglected bank. They're overcapitalized. They have good credit quality. That's everything I'm going to cover. All 6 of these banks have good credit quality and are overcapitalized. So the way we look at banks is it's really, the way I value them is this 3-factor model. So what the bank would be worth if they were to trade in line with peers at the same multiple that peers trade at. What they would be worth to an acquirer. So this is if you were a banker and you could purchase the whole bank, take out all the excess costs, and then put a 10 times multiple on that or so, what would that be worth? And then a discount dividend valuation. So for Sturgis, they trade for 10, and relative to peers, they would be at 21, discount dividend 16, and on acquisition value 25. So somewhere between 16 and 25 is really probably a fair value for this bank, closer to 20. And if that seems, it seems almost arbitrary. What we do is we average these 3 values, and what we found is throughout the banking universe, the average of those 3 values is what we call fair value. Most banks trade for that value. So the market agrees with us. We agree with the market. That's about fair. And so there's a lot of upside with these guys. Next one is SFB Bank Corp. This is a really interesting bank because of what's going on. The bank itself is not interesting. So they are in Elizabethton, Tennessee, which no one here has ever heard of, which is next to Johnson City, Tennessee, which is another place no one's ever heard of, which is next to nothing. And it's just rural banking. They have been, the CEO will say they're proud that they've been profitable for 20 or 30 years. Barely profitable. They earn a little bit of money. And they IPO'd in 97 at 13. Then 2013, they were trading for 15. So no shareholder return for 16 years. And they were just happy with this. What ended up happening was value became its own catalyst in the sense that it was trading at 50% of book, and a hedge fund, Trondheim Capital, came in, started purchasing shares. Shares are up now. They got the news out. A number of other investors who are interested in getting things moving there purchased shares. So now we have this activist situation, and they have an annual meeting in about a month here. Activists will most likely get on the board and probably force the sale of the bank. Management is willing to sell because there's been some rumors that they tried to shop themselves a number of years ago, but they wanted too much money. So they're a dumpy little bank. They're probably worth book 1.2 times book, so about 48. They trade for between 30 and 35, depends on the day. So this is just an average bank, not even average. This is a below average bank, but if they were to sell out, they're definitely worth more. Next is Alta Pacific Bank. These guys are in Southern California, and I love this quote I found on Yelp on them. It says, "This is a small community bank that reminds me of Jimmy Stewart's Bank in It's a Wonderful Life," that iconic Christmas movie. They're just grinding away in Southern California, doing the small town banking thing. 300 million in assets, 3 or 40 million in assets. What's really fascinating about them is they are doing the acquiring. They purchased a business bank 3 or 4 years ago, and then they purchased Mission Oaks Bank in 2014. So this is a $99 million bank in assets. They purchased for $3.5 million. They turned on the growth at both of these banks as well. And that really shows in high returns on equity. So they've done 10% on equity since 2015. They did 7% in 2014. But what's even better is if you look at their income statement. So they had $20 million in interest income, and they had $18 million in net interest income. So they only paid $2 million out in interest fees. And of that, 1.2 million was on some subordinated debt and some FHLB advances. These guys only paid 800,000 on deposits. I mean, it's almost nothing. And to boot, they had only 11 million in operating costs. These guys have about less than 50% efficiency ratio. So almost all the money they're making is just dropping straight to the bottom line. And they're looking to acquire more banks, acquiring these assets cheaply, and then they put it through their system, and they're doing well. So they're 10 times earnings, just about book value. They're probably worth, around 1.5 times book. But at the same time, you could own them as they purchase these other banks cheaply, and so you don't necessarily have to do the purchasing yourself. You could let them purchase the banks. All right, next up we have Mountain Valley Bank Shares. These guys are in rural West Virginia. And if you've ever heard of a one stoplight town, they are almost exclusively in no stoplight towns. So you imagine a couple houses on a street and a couple commercial buildings, and that's where they are. You'd never know they were traded. If you go to their website, it looks like it's from 1992. It tells you how to find their 4 ATMs. I mean, this is just a backwoods type of bank. They're very average, at best average. And so what's interesting about them is they're really the typical case of who could be bought out. And this is because there's a lot of inefficiencies that could be worked out, a lot of duplicate costs if someone were to buy them. The largest shareholder, who was also the chairman who founded the bank, he passed away in 2012. So the biggest shareholder is the Shriners Hospital. They own 7%. I'm guessing that was a gift to charity. And then the wife of the chairman, who is now on the board, and she owns 6.7%. So does the wife of the chairman, does she want to run a bank? Probably not. And as this pressure cooker really presses in on these banks, what happens? I think they're going to end up walking away with a nice payday. So if you look at them, they're at 86% of book, $14 million market cap, $16 million in book value. On an acquisition basis, which I think that's the end game for them, they'd be worth about 30 million. So almost a double from here, essentially. They trade for 35. Next up, we have First Bank Trust. This is a $450 million bank in Illinois. And I consider them shareholder friendly. And this is because when you open the annual report, there's 2 pages. So the left side is 4 charts and graphs of book value per share growth, earnings per share growth, asset growth per share. It's all per share graphs. And then the right side, you have the chairman's letter. Now, tangible book value per share grew from $12 a share in 2009 to the current $20 and trades at